Good evening. Welcome to the Hurley Investments Market View Commentary for Monday, the 22nd of April. When we go through our last one next week, Key Vibey will be taking care of the class for me, as I will be working hard in California, hard on golfing and surfing and maybe doing a couple dinners with some people. But Key will take care of you next week. We'll most likely talk about the end of a month and something interesting that he's going to share. But with that said, we are into our first real week of earnings. I had a gentleman, one of my friends, one of my originals, email me a link that said, hey, by the way, here's a bunch of earnings that are coming up. I do like the picture, so I snapped the picture from Earnings Whisper. Pretty interesting picture just to show you everything that's going on and why. Maybe instead of writing all the earnings in that really matter to me, I should just take the earnings picture snapshot of important earnings in the week and just say, here they are. Take a look at them. Big earnings for us. Hurley Investments probably has 6, maybe 7 earnings that we actively trade that are coming up. It'll be a pretty interesting week for us as I'm taking a quick peek at this. Facebook, Visa will be some big ones. In fact, I should just go to my own stuff. I like the picture, but for me, I can take a look like this and say Visa, Facebook, Boeing, Zions Bank today was one for us. I'll be interested in seeing Ford, FCX, Freeport McMoran, Intel, Tria, Chevron reports on Friday. Really got to be on your game for the next 3 weeks as some big earnings through. Really fast now, the 8th of May. Earnings Palooza. Earnings beyond lower earnings. So I'm interested to make this example. Oh, I'm back. Can you hear me? All right, do I sound better now? Am I back? Sorry about that, guys. Please let someone tell me that I am back so I can keep going. Little part of this I'm gonna have to edit out when it all comes back, but tell me I'm back. Anyone? Can somebody hear me? There we go. All right, sorry about that. Welcome to living up in the mountains. Sometimes you get really crappy internet. But okay, all I was saying is with Hurley Investments, you get excited to see stocks go up as you will going down. I've got an interesting client right? I've got a client that has an interesting perspective that I got to go through Abbott Laboratories. This gentleman has $11,975 or really 160 shares of Abbott Laboratories with a cost basis of $74.83. He bought those $75 long puts for $1.83. And I'm pretty sure they were probably May 24s. If you were to own one share of Abbott Laboratories, it would cost you $74.83. Every penny's at risk. We added 2 contracts on 160 shares. Little extra protection to the downside. Pretty neat because we have the right to sell the stock at $75. Our new cost basis is the cost of the stock at $74.83 plus the cost of the long put for a total new cost of $76.66. But the key question is, what is the risk in the trade? The risk in the trade, you have $76.06 invested. You have the right to sell $75. He only has the risk of $1.66 per share. Or if you can read the total amount on a I'll just say almost $12,000 investment, he has a quote unquote a risk of $265.60, or 2.2% of your total invested capital is at risk. Now I'm trying to help him understand collar trading. This is going to be new. And as you're understanding collar trading, your key behind it is saying, hey, is my audio going out again? Are you guys still able to hear me okay? The key behind it is to say, hey, I am just as excited to see stock go down as I am to see them go up. If Abbott Laboratories was to lose 50% of its value, you would still have the right to sell the stock with a long put at $75 or $12,000 total. In this particular case of the right to, in all honesty, sell the stock. So it's lost half its value, so his 160 shares, he could buy back in at $37.50. He could pick up 320 shares. It is a little more expensive. Initial investment of $12,240.60. He will now have an investment of $12,000. If the stock gets back up to 50, you have twice as many shares. It'd be a $16,000 investment or a 25% return on the stock. That is still $28 below your original purchase price. I don't know how to tell people any plainer. When you take care of the risk, the profits will come. It's really that simple. When you take care of the risk that you're running up against, the profits are going to come. And when those profits come, you're going to be sitting pretty, so to speak. Are there any questions in regards to my numbers on Abbott Laboratories and how important it could be to be protecting your stock ownership? Any questions on these numbers? If you don't have any, type in no. I see a couple no's. Okay, so there is a question. Yes, give me 1 second. Lance has a question. So Kevin, what if the stock only drops 20% and maybe only drops down to $50 a share? Well, $50 a share from 75 would be about a 33% drop. And if you make up, if you have a 33% drop due to the cost, which is 2.2%, basically you'd be making up 31% of a 33.3% drop in the stock. So if you can make up 31% of a 33% drop, why not convert 30% of it, or why don't you spend that money and buy 30% more shares of stock? And buying 30% more shares of stock, you've just increased your stock basis on 1,000 shares by 30%. You now have 30% more shares of stock if Abbott was to go from 50 maybe up to 60. So in all honesty, it's nothing more than giving yourself the ability to dollar cost average without having to spend any extra money to do so. It also gives you the comfort to be able to sleep at night, knowing from an earnings you might not see a 20, 30, 40, 50% drop. So Lance, the same principle stays in place here. If it doesn't lose 50%, only loses a third, goes down to $50, that's a 33.3% drop. You will probably make up 30% of that 33% drop. Take that 30%, convert it to more shares. You now have 30% more shares of stock. While everyone else is just waiting for things to come back, you have the ability to be proactive in your trading or to actively manage yourself to the downside. Pretty neat to be able to do. Pretty neat to take ownership of the downward movements. Now, I know some of you are going to say, well, Kevin, we haven't really had a downward moving stock in 10 years, which is correct. Let me take that back. We've not really had a downward moving market. We have had plenty of downward moving stocks. So in those downward moving stock time periods, for all intents and purposes, you're protecting yourself. You're not in there for diversification in an index. You don't want the bad, the good. You're out there trying to pick the best of the best, doing your fundamental analysis. And the neat thing is, if you're wrong and you get hammered for a while in something like Disney, you still have plenty of time to pick up shares to lower cost basis. And all of a sudden, Disney's going to come out with Endgame and this cool service for only $6.99 a month or $69 altogether. And next thing you know, you have a big pop on 30% more shares of stock and you're in great shape. It all comes down to being patient. And the more patient you are, sometimes the bigger average yearly returns you're going to get. So good question, Lance. Hopefully I've got that answered for you. Are there any other questions about any of the numbers that I've put out here for you guys? All right, this goes to the second thing I want to put into place. Some of you are using margin. So with a show of hands, give me a yes or a no how many of you are in margin? Now, with that said, we had 2 more questions come in. How far in advance of earnings do you buy the long puts? I usually like to go out a couple of weeks. If I go out a couple of weeks, somewhere, I don't know, 2 weeks out, I usually don't have the same volatility crush as I would a week out or a day out. A day out, you're going to lose 20% of the value of your long put price almost overnight. So, in all honesty, 2 weeks out saved you from volatility crush. There are some times you might be moving puts up as you had a pre-earnings run. So it takes, there's no set rule, but 2 weeks if you want to avoid volatility crush and really be ready for all intents and purposes to be able to protect and or to let it run and protect it at a higher price if you have to. Good question. Second question, what if the company goes out of business? I always get that question. And if the company goes out of business, all you have to do is somewhere along the lines add a second long put and you'll make up more than your overall stock base. You'll be in something called a delta negative position where your delta, your protection is outweighing the growth of your stock for a certain period of time, and you're good to go. All right. Show a hand, show a yeses or nos. How many of you are in margin? Lance, I knew you would be, and David, I know you are. If Stuart was here with us today, I'm sure Stuart's in some margin as well. And the key is, let me just make it as simple as possible, a little bit of margin. And I'm going to say maybe 10% is okay. Why would margin not be okay? Why would it not be okay to be or have some margin? Think about it. Why would it be okay not to be in margin? There you go. Too much margin is expensive. Lance, you're on one today. It's expensive. So how expensive is expensive? How expensive is expensive? And that's a pretty interesting question. So if you're in Vanguard, you have a base rate of 7.25. And if you're up to only 20,000 with them, you're going to pay an interest rate of 2.5 plus your 7.25, and boom, you come out to a 9.75. 20 to 49,000, you're going to pay 9.25. 100,000, you can pay 0.75. I mean, with all intents and purposes, even $1 million or just under $1 million is going to pay 6.5%. So let's do the math. If you have $500,000 of margin, for all intents and purposes, you're going to be paying about $32,500 to borrow or use $500,000 in your margin. Worst part about it for Vanguard, if you're doing their mutual funds to do it, you're probably paying an overall net of 9%, if not a little bit more, with other fees that are in place. Could you imagine paying 15.5% just to be in some mutual funds or some type of funds to beat the market? Ridiculous. Schwab, even worse. Even worse. They charge you up one side and down the other. And the sad thing is they charge in tiers. Anytime you know you don't want to work with someone is when they all of a sudden have different tiers. They say, hey, we're going to treat $1 million person better than $1.5 million. That is your easy or easiest understanding to say it is someone you do not want to do business with, because they will show preferential treatment to more money versus less money. TD Ameritrade, their base rate is 9.5. So you'll on the high end do 8, and on the low end you'll be at 11.75. E-Trade's in the mix too. E-Trade's in the mix. There are times though that certain people get certain privileges if it's assets under management. What I'm trying to show you is sometimes when you go into margin, you pay through the nose. Could it be profitable? It could be. Will it most likely be profitable? Probably not. Probably not. So the short answer is be careful anytime you're running into some type of margin situation. A little bit is okay. When I say a little bit, sometimes on a $200,000 account, I'll go in 10,000. About 5%. That's about 2.5% on 5,000. 10% would be 5%. If I'm in $20,000 on a $200,000 account, I start to look to see if it's worthwhile. I'm going to suggest you stay away from margin. Stay away from margin because it's too expensive. Lance, you could not have said it any better. And it's variable all across the board. And not only that, you have to validate it. In all honesty, there are times that you go and you check, and what you think is margin and their margin rate is really their add-on rate, not the base rate. And you think you're only paying 3.9%, you find out it's 3.9%, maybe like an Interactive Brokers that's actually has a base rate on top of that of 7.75. So just be careful. Are markets going to end up higher? I'm going to say most likely. And I'm looking at technical charts for all intents and purposes. As I look at a technical chart on Dow Jones, we're coming off the oversold. It has room to run. S&P, barely off of overbought, have a little bit of room to run. NASDAQ looks the same. Let's face it, we're in a pretty good run right now in our market. And a pretty good run means we could see some pretty good earnings. Overall, maybe the market's going to be a little bit flat for a little bit. Maybe just a little bit flat as we wait for a China deal. But earnings should give us a push. The China deal should give us a catalyst. And then from that point, I don't see a whole lot by way of catalysts. I think for the most part, we're kind of done at that point, which means you got to be ready for a sell in May and go away. As I take a look at April, still a little bit less. I'm looking at the chart. Not a bad run. I'm still only going to give it 3% max. A lot of earnings coming up. I've got a lot of ours listed there. Again, Visa, Facebook, Boeing, Ford, Intel, Freeport-McMoRan, Altria, Chevron, Zions Bank. We got 1, 2, 3, 4, 5, 6, 7, 8, 9. We got 10 stocks that are inactive accounts that are going to be heavily watched by Hurley Investments. Pretty low economic week. We have not a whole lot of economic reports that are coming up. Good week for me to be traveling. Internationally, we have the Bank of Japan interest rate decision. Plain and simple, I am protecting for earnings, and I do have my long puts in place. I will most likely be adding short calls after earnings if I need to on certain stocks. When it came to what I wanted to bring up for you, Apple has 4 terrible options to get the iPhone to 5G, so I went to the least of all evils. If you know what that least of all evils, it settled its dispute with, I want to say Comcast. It's not Comcast. It's Qualcomm, and they're licensing their chips. They apparently have given up on Intel, and Intel said they're not in the race anymore. They also gave up on producing their own. So plain and simply, Apple is here saying, you know what? We're off to the races, and we're off to the races, willing to work with Qualcomm and trying to put our differences behind us. So pretty interesting to see. I'm excited to see how this works out. And for all intents and purposes, I'm going to hold off till we see some 5G chips come into the next iPhone. Yes, I still have an iPhone 7. All my families are iPhone 8s. They are paid off. We do own them. But I guess it's an iPhone II. The iPhone 11 is what I'm going to be looking for from here on out. If you're interested in chip makers lousy first quarter earnings could threaten sector stock, blah, 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 blah. Chip makers lousy first quarter earnings could threaten sector's strong stock market gains, which I agree with 100%. I would definitely suggest you spend some time reading through this. And if you play any of the technologies or semiconductors, it's a pretty good article to give you some understanding of why you need to at least protect those positions. I like the data they've come up with. Last but not least, the Ford Motor presents at the Bank of America. I have the slideshow. If you go to your handout section, you should be able to download a Ford script that they had, their PowerPoint presentation that they had at the Merrill Lynch show. So any questions, any wondering about it, go and download from the handout section of your GoToWebinar, and you will have the exact script that they had that they used to present with at the Merrill Lynch 2019, I guess it's the Bank of America Merrill Lynch 2019 Auto Show. Pretty interesting if you're a Ford follower or Ford believer. Short answer is you can see it from $9.50 up to at least $13, maybe $14 by the end of the year. Nothing more than stripping down the cars that aren't making as much money and holding their dominance in trucks. So with that said, are there any questions that I can answer for you today? I know I gave quite a bit on margin there. So if you do have another question or comment on margin, I can follow that. But are there any other questions you guys have, or shall we call it a night? I do apologize for my internet connection. Again, I am doing this from home tonight, so occasionally I get some bad internet. Fault of living in the mountains. And I guess at the base of the mountains. I'm not really in them. We had a good question from Ida, but I got that one answered. Lance answered yours. David, so interesting question. How do you keep track of all the stocks that you listed last week at earnings? And the short answer is I don't. That is more of a watch list, but it is not everything that I keep track of. I really keep track of about 12 to 14 positions. Some of them I just watch because they've been important in the past and they may become important in the future. But no, I do not watch and I don't actively trade all 25 of those that I gave you. Probably 12 of them are core holdings, and the rest I just I do pay attention to their earnings, but I'm not necessarily trading them. I have them out there for you guys, in all honesty. Did that answer your question there? Because yeah, last week we had a pretty big list of earning candidates, right? All right, hey, you guys take care. Have a wonderful evening. I appreciate you being with me here tonight. I'll probably have to do a little bit of editing, and there's another question. I noticed that a lot of the free emails read buying beaten down stocks. Any comments? Well, yes, it's just downright stupid, Ida. So a lot of the emails that are saying, hey, these big potential returns are stocks that have gotten the hell beat out of them. And sometimes they've been beaten up because they are not fundamentally sound. There's something that has changed with their fundamentals. So when something fundamentally changes, it's been beaten down, it will come back sometime down the road. I really hate those companies is the best way to say it. Most of those companies, in all honesty, are paper traded. They're not traded in real life. Of course, something that's been beaten down has an opportunity to come back. Doesn't mean that it won't come back in the near future, though. It might come back 10 years from now. So pretty dumb, pretty stupid, pretty foolish that people get wrapped up in those. I would obviously think anytime you see one of those type of advertisements, just know it's a crock and you don't want to waste your time, your money, or the mental anguish of dealing with some of their most ridiculous trade recommendations. They're flyers. They're shooting for the stars in a paper trading account that has none of the emotion or the needs of real money that real people trade. So short answer, as you can tell, Ida, when you see those, send them back an email reply that says, stick it. That says, if you're so good, trade money for real, get licensed, bond, insured. Put them in their place. And thank you for giving me the opportunity to say that, Ida. Greatly appreciated. In more ways than you would ever know. So, any other questions you guys have? All right, guys. Hey, have a wonderful week. You'll see us tomorrow for some trade findings and adjustments. We will most likely be working on some protective put opportunities that are out there. You could have gotten out of your Freeport McMoran in a day with a 53-cent return on a 64-cent move on the stock. Pretty nice to pick up, I think it was 4.3% in a day. So interesting. You guys have a wonderful evening. I will talk to you tomorrow night. Bye-bye.